Are you exposed to technology stocks? Even if you are not directly, many stock indices are. Not long ago, the dotcom bubble popped, and stockholders got badly hurt. But dotcom was not the first technology bubble ever seen. The first tech bubble popped in London, 1845. Back then, the novel technology was railroads, which promised to change the world and make investors rich. Let's start our account with the setting: the dawn of railroads in Britain in the 1830s. As seen in our last chapter, a financial bubble inflated in London, 1825. Whereas this bubble focused on mining stocks in South America, some British railway stocks joined the ride. Historians Simmons and Biddle show that over 70 railroads attempted to launch in the 1820s, and 40 of which were approved by Parliament, but only one railroad managed to survive the 1825 bubble, the Liverpool and Manchester line, which finally inaugurated in 1830. Andrew Odlyzko notes that the Liverpool and Manchester Railway was wildly speculative. The initial cost estimate was high, and the actual cost was 2.5 times higher. Nobody knew whether it would be powered by horses, locomotives, or steam engines pulling cable cars. The project almost foundered. It was saved by a large government loan and a large aristocratic investor. But in the end, it did succeed. Why? It stumbled to success by discovering a new market: passengers. Previously, rail was for cargo only. The success of Liverpool and Manchester really changed investor expectations. It discovered a new, unanticipated rail market. Passenger travel also led to greater demand predictability. This rich, predictable stream of revenues led to dramatic improvements in business plans. What happened next? A railroad boom swept Britain, where rail mileage exploded from 98 in 1830 to 1498 in 1840. Odlyzko notes that the British rail boom paused in the mid-1830s. The financial exuberance before then had been fed by general prosperity due to several plentiful harvests, boosted by strong exports to the U.S., which took loans from the British, boosting British exports. In 1837, however, this feedback loop went into reverse after bad harvests in Britain, leading to the defaults of American states and the collapse of British banks. But the 1840s Railway Mania was just around the corner. McCartney and Arnold write that rail shares started to rise in 1843 as the British economy recovered with strong harvests. High earnings were announced by several prominent rail companies. For some time, investor expectations were based on sound projects, but as investors profited in a rising stock market, speculators jumped in, and share prices doubled. The role of a nascent financial media was central in this tech bubble. Historians Taylor and colleagues explain that, as railways captured the imagination of English investors like nothing before, a challenge was posed to the new profession of financial journalists: how to keep track of so many new companies. In 1845 alone, over 1,400 new rail projects were approved. How could the financial press distinguish honest schemes from the dishonest, and warn readers accordingly? A specialist railway press emerged, but objectivity and public service were not the goal. The Railway magazine, for instance, was founded by financier George Walter, a rail investor. This magazine duly printed plenty of positive publicity to the projects Walter had invested in. But not all financial journalists were self-serving. Some actually openly criticized the rail mania in 1845, warning the public that share prices could not go up forever. But the net impact of the financial press was for the mania, not against it. As the stock market boomed in 1845, and British savers craved for rail stocks as touted by the press, a deluge of new rail projects followed. From 1845 to 1847, the rail capital investment in Britain exploded tenfold in comparison to the previous peak year. In a single day, November 30th, 1845, over 800 new railway projects were submitted to parliamentary scrutiny. This was not a boom, it was a mania. Odlyzko writes that this was by many measures the greatest tech bubble in history. In the peak capital spending year, 1847, railroad investments were the equivalent of over $1 trillion for the U.S. today, as a fraction of gross domestic product. British capitalists were then plowing more than twice as much into railroads as the entire nation was spending on the British military, which by then covered an empire with global reach. But this deluge of new rail projects started just as the stock market peaked. What happened next? In the next 5 years, rail stocks gradually slid back to where they started. Whoever bought the peak in July 1845 lost more than 60% by 1850. Who were the investors who lost money in this tech bubble? They included not only aristocrats and smaller savers, but also scientific and literary celebrities such as Charles Darwin, Charles Babbage, and John Stuart Mill. All of them suffered heavy losses. In addition to the financial hit that destroyed the savings or bankrupted many, the economic consequences of this tech bubble pop were also grim. Unemployment rose. Taylor and colleagues explained that the rail industry, which employed 250,000 people in 1847, sacked 200,000 workers by 1850. Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What do we conclude? This is the world's first tech bubble. The 1840s, British Rail Mania captured the imagination of investors with a novel technology that promised to change the world, and many investors were drawn in by storytelling, oftentimes amplified and distorted by the media. As the bubble inflated, hard quantitative analysis was eclipsed by soft storytelling and the promise of quick riches. Does this sound like the dot-com bubble to you? Internet promoters in the 1990s talked about business in internet speed, just like rail promoters talked about rail speed in the 1840s. At the end of the story, both rail and internet did change the world. Some people did get rich, but many lost a lot, and some went bankrupt. What's the takeaway for you? The 1840s tech bubble can be summarized as phenomenal overinvestment in a new technology. The same can be said of the 1990s tech bubble. Both bubbles inspired frenzied investments that would have paid off had society adopted the new technology as fast as promised. But society adopted the new technology at its own speed, slower than that expected by inventors, promoters, and investors. The bubble popped in both cases. Can we say the same about artificial intelligence today? Only time will tell, but we can take a hint from famed investor Jeremy Grantham. He does not dispute that AI will change the world. He does not dispute that sales and profitability growth at Nvidia or Microsoft is fantastic. His point is simple. How do we know whether these AI firms are overinvesting today, just like British rail firms did in the 1840s? All it takes for valuations to come down to earth is a few disappointing earnings reports. As some British journalists mentioned in 1845, these stocks cannot keep going up forever. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community striving to learn from the misfortunes of others to avoid similar fates.